$320,000. Austin, Texas, Duplex, 2 units, both rented, both cash flowing. At least that's what the listing says. Someone sent me this deal 3 weeks ago and asked, "John, is this a good investment?" My first reaction? Excited. Strong market. Tenants already in place. 9% gross yield. Then I ran the real numbers. What I found was not what I expected. There's a trap buried inside this deal, a specific trap with a specific name that costs beginner investors thousands of dollars. By the end of this video, you'll know exactly what it is, how to find it, and you'll never look at a rental listing the same way again. I'm not going to tell you right now whether this deal is good or bad. We're running the numbers live together, and I promise you, the answer is going to surprise you. Stay with me. The trap I mentioned, I'm naming it in part 3. It has a specific name. Experienced investors call it the single biggest killer of beginner deals. Once you know it, you'll see it everywhere. I'm John. This channel is where I document my investing journey from zero. No finance degree, no family money, no safety net. Just real numbers and real decisions. If that's where you are too, subscribe. New video every 2 days. Now, quick context before we run these numbers. I'm not a real estate professional. I'm someone learning this the hard way by doing the math and documenting everything so you don't have to start from scratch like I did. Someone in last week's comments sent me this Austin duplex and asked me to analyze it publicly. So that's exactly what we're doing. And I'll be honest, when I first looked at this listing, I thought it was a no-brainer. Then I dug deeper. Everything changed. We'll get there. Here's the deal as the listing presents it. East Austin, Texas, duplex, 2 units, each 2-bed/1 bath. Asking price, $320,000. Unit A rent, $1,200 per month. Unit B rent, $1,200 per month. Total gross rent, $28,800 per year. And the headline number, the listing leads with 9% gross yield. Austin is one of the most competitive rental markets in the country. Both units are occupied, 0 vacancy at closing. That's the kind of number that makes beginners reach for their phone to call the agent. That 9% gross yield is accurate. It is not wrong. And it tells you almost nothing about whether this deal actually makes money. Because gross yield completely ignores the mortgage, the taxes, the insurance, the management, the maintenance, the vacancy. There's a different number that actually matters. Most beginners never calculate it. That number is coming up next. And when you see it, the deal looks very different. The number that actually matters, it's coming in part 2. And when you see it, the whole picture changes. Gross yield is what you earn before expenses. It's the marketing number. Net cash flow is what you actually keep after every bill is paid. It's the only number that matters when you're deciding whether to sign. Let's build the real picture from the ground up. Standard investment mortgage, 20% down on $320,000. Down payment, $64,000. Loan amount, $256,000. Rate, 7.2%. Today's 30-year investment property rate. Monthly payment, $1,740. Annual mortgage cost, $20,880 against $28,800 in gross rent. That leaves only $7,920 before we touch a single operating expense. That margin is razor thin, and we haven't started yet. Here's where most beginners stop calculating. Here's where the trap opens. Property taxes in Austin run roughly 2.1% of value, $6,720 a year, non-negotiable. Landlord insurance, about $2,400 a year. Property management, and as a beginner, you almost certainly need one, 8 to 10% of rents, $2,592 a year. Maintenance, experienced investors budget 1% of property value, $3,200 a year, for everything from broken HVACs to leaking roofs. Vacancy, even in a hot market. Tenants move. Budget 5%, $1,440 a year. Let me total that up. Total annual operating expenses, $16,352. That's not including the mortgage, that's just to keep the lights on. Annual gross rent plus $28,800 minus mortgage minus $20,880 minus operating expenses minus $16,352. Net annual cash flow minus $8,432. Negative $8,432 every single year, or $702 every month, straight out of your pocket. The deal with the 9% gross yield loses $702 a month. Most beginner investors would have seen that listing, gotten excited, and never run these numbers. They'd have lost thousands and blamed bad luck. It was never luck. It was math they didn't do. I promised you the name of the trap. Here it is, the gross yield illusion. It's the single most common mistake beginner investors make, and it's not entirely their fault because the entire listing industry is built around advertising gross yield. It's the number that sounds impressive. It's the number that generates calls to the agent. The formula is simple and seductive. What it completely ignores: taxes, insurance, management, maintenance, vacancy, and the real cost of the mortgage at today's rates. In 2020, at 3% rates, this exact deal might have worked. At 7.2%, the math is completely different. Same property, same rents, same city. A completely different financial reality. The game changed. Most beginners are still playing by the old rules. The golden rule of good leverage: the return on the asset must always exceed the cost of the debt. This Austin Duplex breaks that rule. Mortgage, $20,880 a year. Operating expenses, $16,352 a year. The property generates $28,800. The cost completely overwhelms the return. This is exactly what bad leverage looks like. Not in a textbook. In a real listing, in a real city, right now. There's a specific purchase price at which this exact duplex becomes a genuinely good investment, not an opinion. I calculated it. I'm going to show you exactly how to find it for any property you ever analyze. Part 4. Let's flip the problem. Instead of asking what this deal returns at $320,000, let's ask what price would make it break even. Operating expenses, $16,352. Gross rent, $28,800. That leaves $12,448 to cover the mortgage. At 7.2% over 30 years, that supports a loan of roughly $160,000. At a 20% down payment, the break-even purchase price is roughly $200,000. This $320,000 duplex would need to be priced at $200,000 to make sense at current rates. That's a $120,000 gap between the asking price and the real investment value, based purely on the math of cash flow. There are 3 specific situations where a deal like this makes sense. Scenario 1, house hacking. You live in one unit, rent the other. Your personal housing cost drops dramatically, and you're building equity every month while the negative cash flow hurts far less. Scenario 2, significant rent upside. If these units are severely under market and you can push rents from $1,200 to $1,800 each, the math changes completely. That requires real comp research before you offer. Scenario 3, a motivated seller. If you can negotiate down to $200,000 to $230,000, foreclosure, divorce, time pressure, the deal works. Distressed sellers exist. This is how experienced investors buy. Outside of these 3 scenarios, the math doesn't work, and the math doesn't care about your feelings about Austin real estate. Before you analyze any rental deal, ask 3 questions. 1. What's my actual net cash flow? Not gross yield, net after every expense and the mortgage. 2. Does that return exceed the cost of my debt? If it doesn't, I'm not building wealth. I'm subsidizing someone else's housing. 3. What's the break-even purchase price, and what specific scenario would have to be true for me to buy above it? 3 questions questions. Every deal, no exceptions. This is the framework that separates investors who build wealth from beginners who lose money on properties that looked great in a listing. I'm putting this as a free checklist in the description. No email required. So, final answer. Is this $320,000 Austin duplex a good investment? As listed with a standard mortgage at today's rates. No, not a disaster, not a scam, just a property price for a world where mortgage rates were 3%. We don't live there anymore. The seller isn't wrong to ask $320,000. It might be worth that to a cash buyer or someone house hacking, but as a straight rental, financed with a mortgage today, the numbers don't work. To the person who sent me this listing, I said, don't buy at asking price, but if you get it under $230,000 or you're willing to live in one unit, it's the answer the math gives us. Not emotion, not instinct, math. If you want me to analyze another deal, drop it in the comments. I picked the ones with the most hidden traps. Next video, in 2 days, we go beyond rental properties. I'm breaking down the one investment vehicle most beginners completely ignore. Zero property management, zero tenants, zero 2 a.m. maintenance calls. And in certain configurations, it has outperformed the S&P 500 over the last 20 years. It's not crypto. It's something far less exciting and far more powerful. Hit the bell. 2 days. I'm John, documenting the beginning of my investing journey so you don't have to figure it out alone. Subscribe for a new breakdown every week. See you in 2 days. In 2